I'm Adam Grimes, and welcome back to Module 4, Unit 4 of the Art and Science of Trading. The title of this unit is Quantitative Techniques 1, and we're going to, so you can imagine, we're going to dig in, and subsequent modules, we're going to go deeper into this. But this is really the first time we have looked at applying quantitative techniques to data. And the rule that we want to guide, I mean, if you think about it, the common sense rule that you would want to guide your actions anywhere is a simple rule that you want to use what works. And you only want to use what works, and you want to ignore everything else. So this is what we're driving toward. And any time we're talking about any trading technique, idea, indicator, system, even maybe a way of thinking about markets, this is the question we want to keep going back to, asking, does it work? But here's the bad news. That's not such a simple question. It seems like a simple question. Does it work? Is it useful? Is it good? Actually, though, all of these things we've been talking about conspire to make this a difficult question to answer in many cases. Why? Well, for one thing, we've talked about the amount of randomness in the market, and you can imagine that trading results, even valid trading results, also have a high degree of randomness. One of the other things that we really fight against, and in this example today, I think it's particularly strong, is cognitive biases. People talk about these more and more over the past 10 years, and there's a module, there's a unit in this course that focuses entirely on cognitive biases. But one that will really affect what you see here is just the tendency to see patterns. And humans are pattern recognition machines. We're very good at it. And this is one of the things that makes us good traders, I think, but one of the skills we can put to use in trading. But it also works against us because we will happily see patterns where none exist. You cannot trust this kind of intuitive sense of, oh, look, that looks good. That may sometimes give us some good ideas. It can also be really, really misleading. So you just can't trust it. You need to crunch some numbers. So we've talked about this idea of how we have to have some edge over the market. And what all this really means is that given a specific condition or set of conditions, there's a higher probability of something happening than another. We think many times in terms of direction. It's not the only way, though. We could think about volatility or something like that, or maybe a market not going somewhere or some relationship happening. But anyway, we define a condition, and we think that when this condition occurs, that there will be a higher probability of something happening in the future. And one of the ways that we make that assessment, and in fact, I would suggest you probably really the only accurate guide we have, is the past. And looking at what has happened historically and making some assumptions about what will carry forward. One of the real problems here is that any test we do is a joint test, meaning it's a test of two things together. It's a test of whatever pattern may or may not be in the market, but it's also a test of the specific way that we are structuring the test. So we're never really just testing the pattern in the market. We're also testing the structure that we put around it and the way we ask the question. And as you know, even casually in everyday life, the way you ask a question can get you a very different answer. That's why political polls are always done a certain way. And in the market, we have to be careful about how we ask the questions. Other complicating factors, and I think that particularly in today's discussion, this deserves some consideration. There are things we cannot quantify. This is, in driving toward the answer to this does it work question, what we're really trying to do is quantify things. We're trying to nail things down. We're trying to look at hard statistics. But there very well may be things. In fact, I would offer there are things that we cannot quantify. And that is going to be a nagging challenge that always kind of works around the margins. The thing that's fascinating about this work is we're dealing with the very edge of what we can know and what is knowable. But we need to be careful about getting arrogant. And it's very easy once we start crunching some numbers and doing some stats to just sort of slam things down and say, I have the answer. Well, we don't. It's more complicated than that. It's also worth mentioning, and technical analysis emphasizes this a lot, that it's possible we might see things that don't have an edge by themselves, but when they're combined with other things, then they do have an edge. So perhaps some things would show an edge in combination, but not individually. Now, to go down this road, we need to be really careful, because just a little detour here. If we ask the question a lot of different times, a lot of different ways, let's just say, let's say we're wondering if the stochastic indicator works. And so we think about, well, if this line does this, okay, that doesn't work. What about if this line does this? What about the relationship between the line? Oh, okay, maybe. What about if the market's above or below a moving average? So we've added something else. What if we have two moving averages? So you see, we keep adding these conditions. And as you go through asking the question over and over and adding conditions, and which you would need to do, I think, to get a valid test of a lot of these combinations, you end up basically fitting the question very well to the data. So you'll get a good answer, but it may not carry forward. That's one of the problems with this. But I got a little far afield with that. This is an introduction, and we can't really do the introduction, though, unless we think about some of the problems we're going to face down the road, and that certainly is one of them. So let's think about traditional technical analysis. And what I am offering in this course, I think, is sort of a non-traditional technical analysis. And we'll talk a little bit later, and I believe in the next module, we'll talk about traditional technical analysis. And we'll spend some time really digging into it. But I want to point out some problems with it. And I'm not condemning the discipline. I'm certainly not saying it's worthless. I think there certainly is value there, but we need to be aware of some of the problems. And to my way of thinking, these are profound problems. So I've just talked about a way of looking at market ideas where we ask questions. It's a scientific approach. We ask questions, and then we think of ways to test those questions to get answers, and then we see what answers the data has. The problem is that traditional technical analysis isn't so into this. In fact, it's actively discouraged in many. There are technical certifications. You'll see people that have letters after their name that says they passed a test and they're an official technical analyst or whatever. But many of these certification programs actually include a rule that you will never question the work of another analyst. And that's one big reason why I have not done one of those tests, because that's not, that to me, that makes no sense. Can you imagine if science worked this way? Well, it did at one time and we didn't make much progress. We move forward by asking these questions. And to me, the very act of developing a trading system is asking these questions and seeing what answer we have. So be aware that technical analysis is not so cool with what we're doing here. And one of the reasons I think is that traditional technical analysis is a visual discipline. What I mean by this is we look at chart patterns. We're looking at heads and shoulders or ascending triangles, things like that. And it also has its roots in what I've called the pre-data era. And what I mean is that you have seen a lot more financial data than any of the fathers of technical analysis ever saw. Back in the day, you might get prices out of the newspaper, and to even construct a chart looking at a few years of data would have been a very, very difficult thing to do. Forget looking at an intraday chart. Forget looking at the thousands of markets that we have today. They just didn't have access to this kind of data. They also did, even if they did have the data, they didn't have the statistical tools. It would have been even calculating a moving average. Go back to the days before the computer. Have you ever thought about that? Put yourself in, between the wars. Go back to the 1930s and imagine that you are a trader who wants to use a moving average. I don't think people were doing that, but imagine that you were. So what would you have to do? Well, you would record prices every day from the newspaper. Maybe you'd go to your brokerage house, maybe there were places you could go to get the information, and then you would have to manually calculate that every day. And tomorrow when a new price comes in, you would have to recalculate the average. Imagine if you wanted to calculate something more complicated, right? But this work that is trivial for us today because the computers do it was quite impossible then. So we need to be careful when we think about when we attach too much significance, I guess, to a lot of, say, the wave theory work. Or we're going to look at ratios today and just realize that came out of an era when people weren't thinking statistically, didn't have the tools to do it. They were basically just looking at patterns on charts. And traditional technical analysis tries to get away with this with what we call hand waving or arm waving. Just say, it's like a complicated problem on a math board and on a chalkboard, and the professor just says, don't worry about it. It works out. And that is the attitude that to the questions we're asking. If you took these to somebody who believes very seriously in traditional technical analysis, who probably has letters after their name, they would just say, oh no, don't worry about it. It works. I know it works. How can I tell it works? Oh, can't you just see it works? Well, cognitive bias. They aren't aware of that, right? So this is something to be aware of. It's one of the challenges. What's our goal today? Well, I want to give you one example of how we can think through a pretty thorny analytical problem and apply some quantitative techniques to market data. I'm not going to give you an answer today. I'm going to show you how one of the ways that I've thought about this question, and we're going to do this. This is not our goal today. We're not going to look at moving averages. We're not going to look at moving average based indicators. That's in the next module. I decided there was, particularly with this introduction, there was enough meat here that we're going to focus our attention on Fibonacci ratios today. And then once we get through this in the next module, we'll also look at some quantitative support for mean reversion and momentum. I'm going to talk a lot here initially about things that we can't find evidence for, things that I would suggest probably, at least based on the data, I don't know what else to base it on, don't work as advertised. But this is not just a list of this is not a dark list of things that don't work. We are going to look at some things that do have a strong quantitative edge, and we'll save that until next module, but it's coming. And of course, the point of all of this is not to be right about anything. It's to move us toward profitable trading patterns. So big breath with me there, and let's look at Fibonacci ratios. So you may be aware of these, but just in case this is new to you, Fibonacci ratios are derived from the Fibonacci sequence. The Fibonacci sequence is produced by summing numbers and then adding the next number in the sequence on and on and on. So the first thing we arrive at is, people will start to generate this sequence with 1. And then you add 1 plus 1, you get 2. You see, each number is just the sum of the previous number. So the first thing people do is they think this is some kind of holy sequence. And they will attach value to, for instance, they'll use 5 for an indicator input, moving average length or something, because it's a Fibonacci number, but they wouldn't use 4, they wouldn't use 6. And that is completely silly. Like the only way you could believe in that is either you're superstitious or you don't understand numbers. Because what we really care about with this series and the, quote, magic of the Fibonacci ratios is what happens as you get out in the sequence a little bit and you start looking at the ratios between numbers that are next to each other in the sequence. And these actual numbers are not important. You can generate the Fibonacci sequence and find the same ratios with any number you start with. If you don't believe me, try it. Do this in a spreadsheet or do it by hand, and you will find whether you start with one, you can start with some gigantic, stupid negative number and some little positive number, and just do the summation process, and you will end up with these ratios. So it's these ratios, really, where people have focused their attention and different ways to generate them. This is also an interesting point which we're going to come back to. Most people that discuss Fibonacci heavily also use 50%. And you will find that 50% is not truly a Fibonacci number. Though, some people might point out it happens, or whatever, early in the sequence. But why do they do that? And I'll tell you the answer up front is that that's the number that actually works. This magical 38.2, 61.8%. I can't find magic. I'll show you how we look for it. So when we think about testing it, the idea here, I think Ralph Elliott of Elliott Wave Theory was probably the person who really started thinking about these. And he looked at these ratios, said they're so important in nature and art and math and, other aspects of math. And there does appear to be some validity. I think that's probably a little bit overrated. And, as a personal note, I did a lot of investigation with Fibonacci ratios. This was before I was a trader, with music, with classical music compositions and different ways that people looked at it. And what I discovered was something very interesting, that people basically fudged the numbers. If it was close, they said it was a Fibonacci hit, but really the times that it would line up with the exact Fibonacci ratios, whatever you were looking at. You can look at a lot of different things, of course. That's one of the other things, that when the pattern and the patterns you're looking for are so ill-defined, then it's kind of an open invitation to just find patterns everywhere. But a little diversion there. He reasoned that since these were so important, they should also be important in financial markets. And the way these are used today is this idea, one of the common ways is that you have a market that's going up and then it pulls back or corrects or makes a flag or whatever. And people will they'll buy at one Fibonacci ratio and they'll put a stop at another. Or they will say, okay, well, this move down is going to hit a Fibonacci target. That's one of the ways so that people are looking at retracements. One of the other ways is to look at how far a market might go as either a percentage, a Fibonacci ratio of this, or somehow with a structure. A lot of different ways to look at these, but that's the idea. So one of the simple questions we can ask is, are swings, this is the key question here, are swings more likely to terminate at or near Fibonacci ratios than any other number? That's the question we're asking. So how do we test it? Well, remember, as I said, how we ask the question matters. And I want you to think critically about my work. I'm not giving you answers here. I'm giving you the ways that I've asked the questions. And I want you to think about what I've seen and what I haven't seen and how I've asked the question. And maybe there's a better way to do it. But this is what I've come up with. So we need to create some system for defining swings in markets. We want to test a lot of these swings. We really need to test a lot of them. I'll suggest another way to do this at the end, but we'll do this kind of automatically. And we want to collect a large number of swings. Let's go ahead and look at different markets, asset classes, time frames. Why not? We can do that, right? And then we'll simply look and see if they terminate near Fibonacci ratios. It's not complicated. In fact, it's such a simple way to ask the question that it's a little bit difficult for me to imagine what could be wrong with this. There are, of course, several places that it could break down. But this is the question, and this is how we're answering it. So defining swings. Well, there are a lot of ways to do this, but I've used a tool that I've developed called Algo Swings. And I'll show you an example of how it works. This uses price structure. Now, this is not any surprise to you that we're looking at a pivot point. So we use price structure and we use volatility. One of the things that I have added with the algo swings that you did not have in your homework, I mentioned this, but basically you don't want to get caught with a lot of little bouncing in here. You want to come off a certain amount to flip the swing. So we require that we come off a multiple of average range from the swing. And you can play with these numbers, and I have played with these numbers. This is a very nice way to define the swings, and it works intuitively. Of course, it's not the only way. If we were defining an upswing, we need to watch for the reversal to the downswing because all of this is backward looking. The highest point of the upswing, as you know, is a pivot high. We're looking for a reversal that either comes off a certain ATR. You could also violate a end-day low. That's another way to do it. A lot of different ways to play with it, and I'll tell you, I played with all of them. Here's what algo swings looks like on a chart, just so you can see. That actually looks kind of reasonable, right? The rule set that I'm using produces pretty good swings. And when I developed this, I also spent a lot of time doing it for myself, and then I had, I think, about 100 traders look at it. and make suggestions for, basically, does it look right? And here I actually have some very nice examples of swings in Apple terminating almost exactly at Fibonacci ratios. So this is what we're looking for. Here is the upswing, and then the correction or pullback terminates at 38% of this previous upswing, 38.2%. And here's one that this particular pullback terminates at 61% of the price distance of the previous upswing. And then here is one. I looked for a while for this chart. This is actually in my book, and it's a good example of why you need to be careful of well-chosen examples in the book, because if I just give you this, your conclusion from seeing this is it works, so you should join my multi-level marketing scheme and trade Forex, and that seems to be a lot of what's going on in the world. But of course, it's not that simple, because this is a very, very carefully chosen example. This is a little bit more complicated, but I want to walk you through how we're actually measuring so you understand these numbers you're about to see. So for every swing, we generate two numbers. We generate an R, and I'm going to call it retracement, and an E, which is an extension. So for the swing CD, this is the swing under consideration, everything references the setup leg AB. So we're measuring this swing in relation to the previous swing in the same direction. The extension is very easy to understand. So what I'm saying here is that this swing is 196, roughly twice as long in price, not in time, but in price, that this distance is twice this distance. So that's the E, and that's relatively easy to understand. Let's look at another one, 154. So that's saying that the price covered here is about 1.5 times the price covered here. And if we look at a downward extension, so now this is a little bit harder to visualize, I think. But so we're looking at this swing, and we're saying the length, not in time, but in price. So from here to here, and from here to here, that this is 93, or a little bit less. So we're always referring back to the setup leg. This would be the setup for a downswing, and this would be the setup for an upswing. That's for the extension. Relatively easy to understand. The retracement, you just have to realize one thing, can be a little bit confusing at first. So that is saying that the retracement that generated this swing, so this swing, is 61% of this swing. Now that may seem a little bit convoluted, but if you measured it and labeled it a different way, you would still find the same results. This is saying that, so we're looking at this as the swing we're analyzing, but we're saying this retracement was 41% of this. So the retracement goes back to here. And just one more, this is 48% of this. So that's what we're measuring. We're looking at each swing, and we're collecting two numbers. The only number we're going to look at first is this retracement number, and the retracement number says this pullback here, how far into this leg did this go? And here are some simple stats. So I just added a simple trend filter, and you can do it without the trend filter, but I basically removed all retracements that were greater than 100% of the setup leg. So what this does is if you have let's see, so you're looking at so it basically will position you with a trend is probably the easiest way to say it. That if we're looking here, let's evaluate this. If we're looking here at this swing, well, this pullback was actually 193% of the setup leg. So that's not a pullback at all. That's actually something more like a trend failure. So if we just add this simple trend filter, and you can do it with or without, but I'll tell you, you basically see the same numbers. So what we see is the average retracement is 65%. So this is what happens on average. Standard deviation is quite large, 20%. The median is 66. And remember, this is kind of hovering around one of our Fibonacci numbers. 61.8 is one of the Fibonacci numbers that people watch, and we're maybe kind of suspiciously close to that. You can look, here are the numbers for equities. Notice there's quite a difference in sample size. And when I redo this work, we'll get the sample size a little bit more even. But you can see that the means are quite, means and medians and even the standard deviations for all of these markets. These are daily bars. You do it on intraday, you're going to see something very similar. They're all very similar. Interestingly enough, by the way, notice what I slipped in on you down here. It's a random set of random markets. And this is kind of a good reality check to stick into a lot of tests like this, because if we find something valid, it should not occur on random data. And when we start to see that the stats from the real things look a lot like the stats, or look basically indistinguishable from the random thing, then we start to kind of ask some questions, hard questions. So I would suggest that if we were to take every retracement, the percentage of every retracement, and that's what we're graphing here on the bottom. This would be the percent R, and we should start to see that there are probably a lot more around these Fibonacci numbers. They need to stand. This is what I'm assuming we should see. This is a histogram of curve, if you will, of the of retracements. Then, if Fibonacci ratios work, I believe we should see something like this. Again, there's an assumption that you should question, but it's just a matter of saying, okay, if these ratios are really important and they do structure market data, then they should show up in the data. But here's what we actually see. This is all of those retracements crammed together with the trend filter, and you can see there's really, is there really anything significant to these Fibonacci numbers, which this one's maybe here or something. And my answer is I don't think so. I certainly can't tease it out. If we look at, and keep in mind, some of these samples are quite small, particularly the 4X, but we're still looking here. Do we see any type of peak, any evidence that these Fibonacci ratios are structuring the data? And I don't think so. Well, so, let's take another cut through the data. And perhaps, we just looked at a bunch of trades and just legs, they could be trades, I guess, but we just looked at a bunch of swings in the market, and you might say, wait a minute, maybe these ratios are only better in good trades. In other words, if we're looking at kind of stuff like this, maybe that's not something we're interested in, but if we have a strong trending market, maybe we're more interested in that. So how can we focus on a trending market environment? As soon as we do this, we're in a little bit of danger, because we're trying to pull out a subset of the data and we risk fitting the question to the data. But let's do it to see. So here were the conditions that I added. I said the length of the extension has to be at least 25% of the setup leg. So we have to go, first of all, at least, say that's probably a little bit farther, but at least 25% of the setup leg. This condition really doesn't add anything, because we already aren't looking at retracements that are greater than 100%. If a retracement is greater than 100%, it will take out the low of the setup leg, so that is not allowed. But this one is critical. The extension must make a new high relative to the setup leg. So that means we're not even looking at it until we take out this previous high. So what this is going to do, if you were to look on a chart, it's going to give us a much higher percentage of trades in strongly trending markets. Many more of these, if you could look back in history, these would be the good trades that you wanted to take. And what do we see? Well, it actually looks quite similar. The numbers have changed a little bit. And in fact, I'm going to flip back and forth because I can do that here. It'll be a little bit awkward. So let me clear these. So here's the original, and here it is with the best trend filter or the best trade filter. And you can see it's moved a little bit. The location has moved a little bit, but that's really, if you think through it, what we've done is, if you think through what we've eliminated, you'll understand why naturally these numbers will move a little bit. Interestingly enough, here's what it looks like. It still looks very similar. We don't see any evidence of this type of peak that we would expect to see around these Fibonacci numbers if they really did structure the data. And here it is broken out, kind of the same thing. So based on this, and this to me is a very simple way to look at the data, but we just don't see anything there. Let's ask another question since we have all of these swings, and you may notice we just looked at the retracements. We can play with the extensions a little bit. So people say shallower retracements lead to stronger extensions. And the idea, I'm just going to completely draw over the screen. I will erase it. The idea is that you have a trending market. And if it just pulls back a little bit, then it probably has a lot of energy and can go like crazy. On the other hand, if you have the same trending market and it pulls back and comes back much deeper into the setup leg, that this is a market that's probably tired and won't do as well. Well, one of the things we can do to test this, we have all this data, so we can play with it, right? If this is true, then shallower retracements should have larger extensions. And that's why, if you go back to what might have seemed kind of a convoluted way, that at this point, the data that I'm collecting gives me the extension with the retracement that set up that extension based on the geometry of the setup leg. What we're doing here, everybody talks about market geometry and sacred geometry and all that. What we're doing is actually looking at that geometry. We're just expressing it with numbers. And if people 50, 60 years ago, 70, 80 years ago had the techniques to do this, we probably would not have all of this kind of weird ratio stuff in the markets because they would have been able to test it, or in the lore of technical analysis. But if this is true, then shallower retracement should have larger extensions. So why don't we just categorize extensions by the side of the preceding retracement? And that's what I've done here. So this line is all of the retracements that were less than 25% of the setup leg. Well, then your average extension is 36% of the setup leg. On the other hand, if we retrace between 50 to 75%, now think about what that looks like. If you're a trader, that means we pulled back to here, and many of us would not be so interested. Yet, look at that. The extension is more powerful. And in fact, if we pull back below the setup leg, so there is no evidence here that shallower, this thing that I used to believe, I almost said we all believe, but this thing that every book will tell you, everybody trading will tell you that a shallow retracement leads to a stronger move. And it does, in fact, sometimes. You know what? You can definitely find examples where the thing barely pulls back and then explodes. And guess what? Those are memorable trades. So we tend to anchor on those. And when we think back over the large set of market data, we focus on these that we have had emotional experiences attached to. Maybe we made or lost a lot of money. Maybe we were proven right on social media and we can go tweet about the stock that went up and made a shallow retracement. And we remember these things. So what I have just talked about kind of in code is some cognitive biases really shaping our memory of these things. The actual data says something quite different. And here's just another way to display the same thing. I'll leave this up for a moment so you can think about it. But this is the Dow Jones Industrial Average. This is all the swings on the daily chart between 1920 and 2013. So we're looking at a lot of data. And what I have done here is characterized each, we did the same thing for each swing, the retracement and the extension. And I plotted the retracement on the bottom and the extension on the top. So if you had I'll just make some dots. If you had, let's just say, a retracement that came back 50% and then went 100%. So that would look visually like this, where this leg is just as long as this leg and this leg is 50%. that data point would be here. It's 50%. I'm sorry. No. Yes, it would. Yes, it would. That's where it would be. And if these shallower retracements lead to more powerful moves and deeper retracements lead to crummier moves, then what we should see is here a lot of data points up here. And here, for these deep retracements, everything should kind of cluster here. But I don't think we see that. And in fact, all of the big swings were set up by powerful deep retracements. So that's just also another aside. So what do we think about this? Well, you have to realize that if we're thinking scientifically, we can't disprove this. And in fact, that's not really our job to disprove something. We're looking for evidence to support it, but no matter how I have looked at this, and maybe you'll find some other way to look at it, I can find no evidence that Fibonacci ratios describe important structural points looking over a large sample of markets, different time frames, different time periods, different market regimes, different asset classes. No matter where I've looked, I can't find it. Also, the received wisdom that smaller retracements lead to larger extensions is strongly contradicted by the data, which is a nice way to say it really looks like it's not true based on all the market data we have to date. So, I don't know what else we would base it on. Filtering for the best trades did not do much to affect results. And I'm showing you kind of the tip of the iceberg. I've done a lot of testing on this, and I've already talked longer than I thought I probably should here, but this is a serious, important thing to think about. So what are the lessons that I take away from it? I guess I will say your lessons may be very different. Let's say these are Adam's lessons for Adam, not from Adam. But I believe that it's likely a serious mistake to use Fibonacci ratios in any way whatsoever. I instantly ignore and discount any analysis or anybody talking about Fibonacci ratios because my work on them has suggested that the only way we can believe this is if we haven't done the work or we don't understand the work. This challenges, of course, many beliefs and much of the literature, and many people selling tools and newsletters based on Fibonacci. Just do be aware that when we think about, sometimes we think of these beliefs like they're some kind of holy thing we can't challenge, but much of the literature is really based on superstition and these weird appeals to authority. A very famous author, when he read the first edition of my book, took serious issue with my issues with Fibonacci. And one of the arguments he threw back to me was that the height of the Giza pyramid, measured in inches, is a Fibonacci number. Not a Fibonacci ratio. It's a Fibonacci number. Well, I'll let you think through that, okay? And this is a person who develops trading systems and sells a lot of books and stuff. First of all, two things to investigate. Just kind of basic. When did people start using inches versus when were the pyramids built? And also, do you think the pyramids eroded at all? Do you think there was a capstone? And of course, it's silliness to me. I may have missed something. I try to be open-minded about this, but the more, with this particular thing, the more I look at it, the more I hear the nonsensical things believers say, it's difficult to be open-minded, but I certainly may have missed something. And it's very, very possible that somebody watching this may see something I've missed, or you may find a way. And I've asked many, many people over and over to show me some quantitative support, and ... But there may very well be something out there. Certainly is not conclusive disproof, but I would think that with something that's supposed to be as important as Fibonacci, if it's real, we should be able to see it in the data. So what do I do with this? Well, there's a good thing here. There's a practical takeaway. I look for retracements to terminate around 50% of the previous swing with a big margin of error, with a big margin of error. And that is a very useful trading principle. It would be silliness for me to put a stop at a 61% retracement level. It would be silliness for me to draw any kind of retracement grid. But if I have a market that's now pulling back and I'll say, okay, 50% is kind of where I expect it to go, but then I also know that there's this giant, big, fuzzy place from which the move back up could emerge, and I also know that it's okay to buy those deeper retracements. Well, that affects my trading in a positive way, and it's supported by the data, and it doesn't require any wishful thinking. So think about how you can continue this work. And one of the things that you might do is do some very careful analysis and maybe go back through a bunch of charts. Maybe there's value in doing this work manually. And this is one of the questions, right? Maybe there's value in doing this manually that the quantitative tests miss. If you do that, you need to be careful of look-ahead bias, and we're going to talk about that in another unit here very shortly. And you also need to be very, very careful of cognitive bias. And just be aware, any line you draw on a chart is going to look important. So you need to respect that and respect that is a part of your cognitive machinery, and there's no way around it. So just be aware that you're going to need to actually crunch some numbers, and you can't just draw a bunch of lines on charts and say they work. So in the next module, not another unit here, but in the next module, which you'll get to in a few weeks, we're going to look at some other ways to analyze patterns and think about some of the other problems. But this was what I hope was an interesting and useful way to think about a market problem. And I hope you can take two things from this. I hope you can take this idea, this way of looking at market data critically, asking questions, looking for answers, thinking about what you might have missed, kind of that whole thought process. I hope you can take that away. And I also hope you will think about Fibonacci numbers and Fibonacci ratios a little bit differently, and at least maybe think a little bit critically and ask some questions for yourself. Thank you very much.